Very good. So good afternoon, everybody, and welcome to the second of our Life Sciences Live series of webinars. I'm Ian Oliver, and I lead the Life Sciences practice of BDO in the UK, as well as being a financial audit partner. A little bit of housekeeping, just to start off with. The webinar is being recorded today, and a copy will be shared with all attendees and available on our website for future viewing. We will have a live Q&A session at the end of our speaker presentations today. But if you think of a question during the presentations, please do include it in the Q&A function on Zoom. And depending on the number of questions, we may try to cover some of these after each presentation. So moving on to the agenda for today. So first up, Alex Mackay will talk us through M&A trends in life sciences and also optimizing value from a sale process. To transactions. And finally, Samantha George will talk us through accounting issues on deals. But just before we get into those presentations, I wanted to start by providing some brief reflections industry during 2020, in particular with respect to biopharma, just to give some context to today's presentations. In terms of the 2020 share price trend, in many ways in 2020, COVID-19 really turbocharged an industry that was already riding fairly high. With the spotlight on biopharma, which made remarkably swift progress on a pipeline of pandemic therapies, investors rushed to inject money into the sector. This also resulted in ballooning stock market valuations, with the top 600 global biopharma companies adding nearly $500 billion or 11% to their starting valuation of just under $4,600 billion. Those developing COVID-19 vaccines and treatments drove those gains, with several small developers transformed into multi-billion-dollar enterprises. The vaccine developers Moderna, BioNTech, and Novavax especially stand out. It was also a really big year for biotech quotations. The financing climate has been strong for a few years, but 2020 saw records broken in the venture and IPO worlds. An astonishing $12.7 billion was raised on Western stock exchanges last year by 76 young drug developers via IPOs, a figure that outstrips previous records of $7.2 billion by 68 companies in 2018 by a long way. IPO size grew by 57% over 2018 to an average of $167 million per IPO. And a real feature of IPO transactions last year was the use of special purpose acquisition corporations, or SPACs, which are essentially pre-funded and floated shell vehicles with a particular investment focus for the use of their float proceeds. On the venture financing side, 450 private biotechs developing therapeutics raised $20 billion last year, eclipsing the previous 5-year best of $17.8 billion in 2018, with an average round size topping out at just under $45 million. And the growth trend certainly doesn't look like abating this year. And finally, on the drug approvals side, during the course of last year, the US FDA approved 57 novel medicines, which is second only to 2018, with 61 approvals. The mean time to approval reduced slightly from 2019 due to the number of submissions under priority review. Despite some high-profile rejections, sales predictions for those approved include a small number of blockbusters alongside a majority of orphan or niche indications. The main COVID-19 focus this year is set to switch from tests for the disease to the progress of vaccines and therapeutics against the pandemic. And given the financing statistics for the first quarter, 2021 looks set to break many records again for the industry. So moving on to the presentations now, and I'll hand over to Alex.
Thanks, Ian. So I'm Alex Mackay. I'm a director in the Life Sciences M&A team based in London. So we're a team of 15 people that works very closely with different service lines and different offices around the UK. There's probably three differentiating features for our team. So we advise on company sales, acquisitions and fundraising activities, but we also have a growth strategy and commercial due diligence team that sits within our team as well, who work on M&A transactions. As part of that, we have a team with a pretty broad range of backgrounds. So you've got the typical finance backgrounds that you have, but also we've got a cardiac surgeon, a couple of pharmacists, a chemical engineer, and someone who used to work in laboratories. So just to give a bit of context, so there's quite a round of deep industry expertise as well around our team. And we also work very holistically with other teams. So, for example, Carol's tax team will come on to present the next talk, but and also on the operations side. So what we're very geared up to do is to support businesses in the approach to and during the transaction to help optimize value from a sale process. And we'll come and talk a little bit about that later on in the transaction. So just moving on to M&A activity in the UK, as you can see from this graph, so BCPI is a review of the deals that are done each quarter in the UK market. And you can see from this graph that there was a significant drop in Q2 2020 due to the lockdown, and that's subsequently recovered in each subsequent quarter through to Q1 2021. What's also noticeable here is that the private equity transactions have picked up some of the slack that were in Q2 and Q3 of 2020, and obviously there's constraints on private equity funds who raise money to invest over a particular period of time, and so we've seen a real rebound in transactions. Just going on to the next slide, you can also see here from pricing. So this is EV/EBITDA multiples, EBITDA being a proxy for cash flow, were depressed around Q2 2020, and we've seen that recovering not just in terms of private company transactions, also in private equity transactions returning to more sort of normal levels, and in the FTSE All Share, that's reached a new peak over this time period, and that's partly due to the fact that the profitability looking back over that 12-month period has been somewhat depressed. Just going on to the next slide, we talk a little bit about the share price performance of life sciences companies. So what we typically see in periods of downturn is that life sciences companies tend to outperform the broader share indices. So this is looking at the FTSE All Share and the S&P Life Sciences Index. So they're pretty closely aligned up until the period of lockdown. And then what you can see is there's been significant outperformance in life sciences companies since that period of time. And there's a number of reasons that's unpinned that, but clearly there's long-term investment cycles, some very supportive macro trends like aging populations, etc., that continue to support even during these periods. And then the life sciences companies don't typically tend to be impacted by factors such as consumer demand, which can fluctuate more wildly. In terms of attractive subsectors, just moving on to the next slide, and there's a few areas here that we've seen a particular uptick in interest from both from listed businesses, from other private companies, and private equity-backed businesses. So in the drug commercialized, a lot of these areas are focused around the outsourced pharma services sector. So I think across the life sciences sector in general, there's been an uptick in interest, but there's been particularly prominent within the outsourced pharma services sector. So this is companies supporting activities that would have been done historically by pharma companies, but increasingly being outsourced for reasons of cost and innovation. So on the commercialization services, there's been a significant amount of activity in medical communications, market access businesses, and there's been a noticeable uptick in valuations there. Similarly, on drug research and development, we've seen a lot of interest in businesses, particularly those that have got some sort of tech angle within them. On the supply chain, the manufacturing and supply chain, there's been interest, but particularly around areas that supply from a COVID perspective. Digital health, remote patient monitoring, and service delivery have seen a significant rise in adoption over this period of time, and we're seeing a high degree of interest in that space from investors. And finally, COVID, so anything to do with vaccines, diagnostics, and treatment has been a particular hot area for investors. Moving on to some of the market drivers that underpin some of this growth. And I won't cover all of these because there's quite a few here that are listed, but just want to touch on a few. So there's been a pretty steady increase in R&D spending over the last few years now that just continues to sort of support and feed into the wider sector. And there's also been the trend towards personalized medicine. I mean, the more drugs in each phase of clinical trials, and there's a lot more activity from that perspective. Been obviously strong focused on cost-saving measures and innovation as pharma companies look to retrench into areas they feel they can really specialise in. And there's been a lot of COVID demand as well from various different areas that have lit up in terms of demand. Finally, obviously, there's a broader theme around technology and data that's definitely having a strong impact in the sector, and businesses that have a tech or a data angle have received particularly high valuations of late. Moving on to some of the future themes. So there's a few themes here we've picked out. So obviously there's some trends that have been prevalent for quite a while now, but we'll also pick out some emerging themes I think are particularly important from an investor landscape. So healthcare as a strategic infrastructure, so no longer seen as just an area where there's cost to be managed, but seeing real competitive advantages at a regional and a national level for a healthcare system that's able to support and keep the economy going. Linked to that, the requirement for an agile healthcare capacity to be able to respond to fluctuations in demand, and the requirements for redundancy to cope with capacity constraints at certain particular times. I think we'll see new standards of hygiene being adopted in many areas, not only in the home, in travel, in care settings as well, and there'll never be investment that will go behind that. The remote delivery of healthcare is obviously a trend that was set to continue, but obviously it's been significantly accelerated by the lockdown circumstances, and localization of manufacturing and supply chain. So a lot of supplies are typically required on a global supply chain. Increasingly, I think we'll see some more onshoring and of certain vital areas, and to make sure that the local and the regional and national supply chains are well placed. So just moving on to optimizing value from a sale process. There's a few themes here from some of the processes we've been involved in over the last 12 months that I think are particularly pertinent to draw out. So we recently undertook a survey of private equity firms who are obviously very sophisticated buyers and sellers of companies, and in 95% of instances they used vendor due diligence as part of their sale process when they're exiting assets. So the benefits of this are that if you conduct vendor due diligence as a party selling the business, you are able to identify and address some of the issues that would typically come out later in a sale process and could impact value, or ultimately the deal even being done in the first place. It also it shortens the back end of the process, so you're able to get people through the diligence process earlier and have a shorter period of exclusivity at the back end. And once you're into exclusivity, you lose that competitive tension, and therefore that can also have a big impact on valuation. So we're seeing the use of vendor due diligence across financial, tax, commercial, legal, but also other areas as well as a real driver in processes. We've also seen private equity and private equity-backed businesses compete very aggressively relative to trade parties. So in the past, trade parties were able to compete because they have synergies they're able to extract from a process which, as a financial standalone acquirer, you aren't able to achieve in quite the same way. Some of the dynamics are underpinned by the ability to be able to raise much more debt to be able to fund a transaction, and that's making people very competitive on pricing. So we're seeing private equity compete with, and in many cases outbid, trade parties, even very large listed businesses in transactions, and be successful that way. Succession planning and the strength of the management team is often a very important parameter and a very important consideration for investors, particularly private equity. So ensuring that you come to market with the right sort of management team in place and the right gaps plugged and obviously bedded into the team is the ideal place to be to make sure you get best value from a transaction. We're finding that focus processes where you really understand the buyer group and they really understand your sector and your business and are also in a position to pay the best price and making sure you build a process around those is critically important. So it's really important to understand the sector, to be talking to people and the right people in the sector to be able to make sure you bring these types of people into the process. And the last two, preparation and investing time in the process, from our perspective, are critical. You know, we can run a process in a very short period of time and have quite a short and punchy process. But in order to deliver best value, typically we find, and this is a distinctive style that we have, is we like to work with companies over a longer period of time to make sure we prepare them in coming to the market, to make sure that the deal issues are resolved or at least addressed, and we can really get the equity story right to present it in the best possible light, so we get both the best value, but also make sure that we have the highest chance of the transaction succeeding. Just flipping over. We've got a bit of a booklet here that talks about some of the areas you might want to think about from preparation perspective. So this is a bit of a high-level summary, but just going around this wheel. So strategic and commercial, you obviously want to make sure that you understand the market drivers and are able to contextualize your strategy within that market context. So being able to get that right and position it in the right way is very important. Business controls and making sure you have the right financial information, the right regulatory requirements in place is obviously very important from a risk perspective, and we often find processes can get impacted by the quality of the information and the lack of confidence that might transmit to buyers in a sale process. People we talked about, obviously making sure we've got the right organisational structures in place and plans for succession, particularly for entrepreneurs who are looking to exit over the next year or two. Cash optimisation, again, is another piece that is often overlooked. So people often focusing on EBITDA and profitability, but ultimately, and particularly for private equity, optimization of cash and how your profit converts into cash is a very important part of capturing value in a sale process. On the digital side, we often see that businesses have got well invested infrastructure that tends to be perceived as more robust, and then typically commands high valuation. So again, there's certain things here where you might want to consider investing a little bit ahead of a process to make sure they have in place, and there's a bit of a runway of growth, not just growing up into the point of sale. And finally, being able to run a very slick process, so making sure you've got really good alignment of stakeholders, a lot of focus at the board level, and able to run a very competitive and compelling process to make sure you attract them up the widest possible interest, get the best possible outcome is obviously critical for optimizing value. So there's a quick run through there, but we can obviously take questions later on, but now I'll pass over to Carol.
Great, thanks very much, Alex. Afternoon, everybody. My name's Carol Lepage. I'm a tax partner with BDO, and I head up the life sciences tax team for the firm. As Alex said, I also work very closely with him and his team on M&A transactions as well, so that we can give that kind of holistic approach to our clients when they're doing deals. So just to put what I'm going to talk about in context, I'm obviously going to talk about tax and transactions. What's the potential journey that a number of life sciences companies will have gone on before they get to that sales process? So the sort of earlier stages are like to include the company being founded, so there'll be tax registrations, payroll to set up, etc. You may then need to go on and get some seed funding, so you might look to tax efficient release for investors such as the Enterprise Incentive Scheme and CDIS as well, and actually need to make sure that you're attractive to those investors and that you meet the conditions. You might need to attract talent, which could involve tax efficient option plans, for example, the enterprise management incentive options, which are very typical for small businesses, as they're the most tax efficient game in town. And then you'll be looking at, maybe using contractors, what other sort of remuneration and benefits you're going to give to your employees. You're likely to be doing some sort of R&D, perhaps, to create IP and actually give you that platform for your business. R&D tax credits are very valuable in that early stage, so I expect a number of you are aware, and you are able to surrender tax losses for R&D credit cash as well. So that is often a good source of funding in those early days. Then lastly, you might have some other further funding as well. You might have gone around through a Series A, for example. But all of those things have tax aspects to them. They're all very sort of embedded in the commercials of the business. And they're all the sorts of things that could well come under scrutiny as you go into and through that deal process. So moving on to preparing for a transaction, I tend to group this into two buckets, really, one around the company and one around actually the shareholders and what they need to think about. So from a company perspective, as Alex said, from a commercial perspective, preparation is key. And that's also true for tax as well. So you want to make sure that everything you have around tax is under control and that you can give that really kind of happy, smiley feeling to a purchaser that, there are no surprises and you've really got a handle on it. So it's things like making sure that your tax compliance is actually up to date, making sure that you're aware of any tax risks and you know how you're going to handle them or you're going to address them beforehand. Have you got any inquiries with HMRC, for example, that you need to be dealing with? And then thinking about, again, with that kind of management team being key, have you locked in the key employees early? Have you got everybody aligned, et cetera, and what's the tax lens on that? Plus, there might be some pre-transaction restructuring needed. For example, if you're planning to do some sort of IPO rather than a private equity sale, that's quite a common thing to need to do and can introduce some tax complexities. So from a shareholder perspective, it's all about making sure that you know in advance how you're going to be taxed, what's acceptable to you. Do you want to exit? Are you expecting to kind of stick around for a bit? Would you like to take everything as cash if you could? What degree of earnout would you accept? Loan note shares, that kind of thing. And what's the consequence of that from a tax perspective? Business asset disposal relief is the new name for entrepreneurs relief, and a number of individual shareholders clearly would want to qualify for that. It's now £1 million lifetime sort of bucket of gain that you can realise at a 10% rate of tax for capital gains. So it's still valuable and definitely worth considering whether you qualify for that. And then also there are situations where certain returns could be taxed maybe as income rather than capital, which again, an awareness in advance might mean that you can do something about the way that things will come to you in the transaction. Lastly, again, do you want to do any pre-transaction steps like giving shares to family, for example, maybe contributing them into a trust? Just thinking about that and proactively managing your position. So moving on to the tax areas to consider as you actually prepare for sale. I thought it would be worth just running through probably the top due diligence issues that we see very regularly with life sciences business, and actually the vast majority of this is relevant regardless of sector. So starting with share related issues, this comes up again and again. Any private company being sold, there will be something share related to cover. It's fundamental to make sure that your option plans have actually been implemented properly, they're working as intended. It's particularly important if you've got, for example, tax efficient EMI options where they're going to actually become exercisable, say on a sale, because you want those to not attract payroll taxes. But if they've not been done properly, there's a risk that there could actually be some payroll tax for the company being sold, which the buyer would clearly care about. There's also a situation which you always look at in a due diligence when you've got employees or directors owning shares. And if they haven't made certain elections, there's again a risk of payroll tax on some of the proceeds on sale. So it's always important to kind of look at that position as well. Employment tax related stuff particularly focuses at the moment on whether your contractors are really employees. You've probably seen in the press that the rules around what's called IR35 came in from April 21, and that effectively means that contractors who are de facto employees do have to go through effectively the payroll of the end user. So that kind of distinction is very important in the due diligence. R&D tax credits, clearly fundamental for businesses in the life sciences sector, will come under scrutiny, particularly as they're often turned into cash through surrender of losses. So all manner of issues can come up on this, partly in terms of what costs have actually fed into your credits, and then even through to have you surrendered the right amount of loss from doing a tax comp based on correct accounts. I have seen situations where actually the accounting records were not under proper UK GAAP, and that can cast doubt on the tax position and the credits. There's a lot of international tax aspects coming up, even for smaller businesses nowadays. Clearly with COVID, there have been a number of businesses where they've got employees suddenly working from home overseas. More generally, there may well be people travelling overseas as things get back to normal or pre-COVID, and that can result in some sort of social security or employment tax obligations in the overseas countries, and also potentially some sort of corporate tax risk depending on how long people are there as well. A couple of other compliance aspects to think about. Watch upstream loans to shareholders. They can trigger, it's only a cash flow thing, but they can trigger a cash flow cost and potential interest and things to think about in a diligence. And secondly, I thought it's worth just touching briefly on the corporate criminal offences rules, which are effectively rules that mean that companies can be subject to effectively unlimited penalties if they don't have suitable procedures in place to stop employees and suppliers from facilitating tax evasion. And this is important because A, the penalties are unlimited, and also because in transactions nowadays, you will quite probably be asked by your purchaser to warrant or indemnify on the corporate criminal offences rules. So actually you might have to indemnify any exposure that comes up from a pre-acquisition period. So a lot to think about there, and you'll have seen the overlap with the steps effectively that you're likely to have gone through in setting up the company. So it's always worth to think about tax as you go. So you get to a sale. Question first is, what structure are you going to get for that sale? What's your consideration going to be? Are you going to fully exit? Are you going to get some cash and maybe roll over some of your proceeds into new shares or new debt, or both in the new world? And that sort of rollover is particularly common in private equity transactions. If you are rolling over, you're quite likely to want some tax clearances, which can impact on the timing. It's a 30-day turnaround from HMRC, but they can ask questions, and that can really drag the process out as well. And it's always worth thinking about whether you actually want to defer the gain on the shares that you get, for example, in that sort of scenario, which is the default position. But in some situations, you can actually trigger the tax now, which you might want to do depending on your view of future tax rates. Thinking about the transaction structure further, you quite often might be offered some sort of earnout, particularly in a life sciences business where you might not be at the point where you've got a real sort of trusted revenue stream from your IP, but the potential is large. And it's worth noting there that you have to value your earnout at the date of transaction, even if you're going to get it over the next 2, 3, 4, whatever it is, years. And the value of that earnout is taxable to capital gains tax on the date of the transaction. And I have actually seen deals fall over as a result of that, because you might be offered a fairly modest amount of cash on day one, but then a very potentially large earnout depending on future performance. And you can get to the point where actually the kind of cash on day one is not really going to be enough to cut it. So it's worth being sort of proactive in terms of how you structure your transaction with that in mind. You can adjust later on for if you got, say, more or less under the earnout, then that is adjusted later. But it does add some complexity in terms of a cash flow for your vendors. It's also worth bearing in mind that if you're, for example, employed in the new world and your earnout is somehow linked to that, that can trigger some employment tax considerations as well. Moving on to key individual retention, as Alex said, it's very important to make sure that you have the right people in place and that they are embedded in the business. And they quite often would be offered some sort of equity in the new world, maybe shares in the kind of new private equity vehicle, for example. So there are a raft of issues to think about there in terms of the tax consequences for them, and making sure that they are retained and that they're aware of their personal tax on that. A couple of other points just to note as well. If you have got option exercises at the deal, it's important to make sure you do them right to maximise the tax deductibility for corporate tax purposes, and also to think about who's going to benefit from the resultant deduction if that's a negotiable point in the transaction. Lastly, just touching on transaction costs, always worth thinking who's funding those. Is it the shareholder vendors? Is it the company? Because certainly from a corporate tax perspective, you know, once you get into that kind of true sales sort of bit and the transaction itself, then tax deductibility is limited. So moving on to final slide. Few key questions just to ask yourself on tax and to take away. I'll leave you to peruse those, but the really key thing is that tax needs to be considered along the journey as you move kind of through almost the setup and getting going process of your business through to actually thinking about sale and preparing for sale, and then actually the sales process itself. Otherwise you can end up with some nasty surprises that can either sort of lead to some sort of price chip, or in an extreme situation could even you know, scupper a deal, which would be disastrous. So do think about tax as part of the whole deal process would be my key takeaway message. So on that note, I am going to hand over to Sam.
Okay, thanks very much, Carol, for that. So good afternoon, everybody. I'm Samantha George. I'm a UK Chartered Accountant and a Director in our Business Services and Outsourcing team. I also lead on domestic outsourcing for life sciences clients. So our team actually undertakes multiple services. So we do everything from financial reporting advisory, bookkeeping, payroll, management accounting, and provide that support globally as well under many global services. So today is very much a generalist view of this. We've given you a tremendous amount of detail already, so do pop your questions in the chat if you have any in the question and answer session. Just moving on to the next slide. So the things that I'm going to cover are some of the typical accounting things that come up as we look at sales and purchases agreements, whether for the seller or the buyer. And typical accounting matters touch on definitions, pretty basic. The legal documents obviously full of definitions, and they're really important to get right because they're very much the nuts and bolts upon which the consideration price is then built. I'll touch briefly on the completion accounts mechanism, a little bit on consideration adjustments, just touch on a locked box mechanism and leakage provisions, and then finally just touch on some of the accounting warranties that can be seen So just starting on the accounting definitions. So I had a list on the previous slide, and I guess, you know, it's even things like cash. It's important to say, you know, you'd think cash would be really straightforward, but in actual fact, there can be kind of half a page of text around the definition of cash itself within the sales and purchase agreement. So moving on to the completion accounts mechanism. What are they? Well, obviously they're very much special purpose accounts drawn up, you know, the clue is in the name, as at the date of completion. And it's very much that snapshot of assets and liabilities within the business at that completion point in time. So there'll be a headline purchase price agreed for the business that will be based on target levels, and that will be able to be adjusted based on perhaps net assets or on working capital and net debt. But what's the goal really? Well, the goal is to make sure people know what they're buying, what they're paying, that they're going to actually get what they're seeking to. People are seeking to get, and the seller avoids giving away value effectively. So back to those definitions again, need to set an appropriate basis for the preparation of the completion accounts. And also, of course, the seller and buyer may not agree, and there may be a dispute. So there needs to be an appropriate process there as well. If we move on to the next slide. So this is an example of a completion accounts mechanism. So on the left hand side, you've got the cash in the business, the debt in the business, you've got your target working capital. Your actual working capital at the date of completion may actually be different, so there'll be a working capital adjustment. And on the right hand side, you'll see effectively the consideration being the enterprise value plus or minus the debt changes and the working capital changes, really giving you your purchase price. And you'll see there the definitions come back into play, don't they? Cash, what is cash? Net debt, working capital, etc. So hugely important in a legal SPA agreement. Next slide, please. So in terms of the preparation of the completion accounts, these don't have to be statutory accounts. So, and it's important to say that they can be statutory accounts, and buyers may wish for a set of accounts that show a true and fair view. But in that case, you're looking at compliance with UK GAAP, generally accepted accounting principles, or IFRS, International Financial Reporting Standards, as the case may be. And there may also be Companies Act disclosures that come into play there. So there is a choice, but obviously there is a higher cost if you're seeking a set of accounts that will bring true and fair into this. So you've then got to agree what are the policies behind the preparation of these accounts. And so, you know, there can be specific policies, things that you want to make sure are in agreement between the parties. You also want to make sure that you've got consistency with past financial statements available through Companies House, of course. But if you're starting to change accounting policies between your previous accounts and your completion accounts, then it could be argued you're comparing apples with pears, which, as we all know, can't be done. And therefore, you do need that consistency point coming into play. UK GAAP, IFRS, hugely complicated in terms of some of the items that we're seeing in the accounts. Fair value adjustments may come into play. I'll touch on that a little bit later. But obviously, one party will prepare those accounts, the other party will review the accounts. There may well not be initial agreement. If those disagreements can't be ironed out, then through a period of negotiation, then there is an option to refer the whole thing to an independent expert, typically an independent firm of chartered accountants, for determination. And obviously we undertake that work as well as the work that Alex has been talking about. If we move on to the next slide. So let's assume the consideration is agreed. Then there can actually be adjustments to the consideration when we get to the final stages. And this is a pretty simple formula, but actually there is a huge amount of work that goes into the background for this. And therefore, there's we would encourage people to reach out and talk to us at early stages on some of these items. You'll see there's an agreed completed net assets amount of £X. X does mark the spot, and the team can certainly help you in terms of being able to get close to that amount as possible in terms of undertaking transactions and helping you through those. Carol touched on perhaps deferred consideration and earn-outs earlier. We're certainly seeing, I think, through the pandemic that a proportion of consideration is being deferred, and that's something that we can touch on more in questions if there's any interest there. I also touched on fair value adjustments earlier, and I guess one example of that, it would be, for example, director and shareholders loans, where maybe there's a loan from a director or shareholder, and there may or may not be an interest rate attached to that. An adjustment on complicated loans is needed to fair value, and if that loan actually has an interest rate that is lower than the arm's length market rate of fair value, that would be different, then there will actually be an adjustment to the profit and loss account within statutory accounts for those types of loans, and you may see that coming through here. I'm not going to go into depth on fair value adjustments. I think for our viewers, if you have an in-house finance team, they'll be aware of this. If you don't have an in-house financial team, then again, that's something that absolutely we can support you on. But one final complexity on it is, of course, that the definition of fair value under UK accounting standards, financial reporting standard 1 or 2, it is different to that within international financial reporting standards. So very much do reach out if you need help on that matter. If we move on again, so I want to touch for a second on Lockedbox completion mechanisms. For any Americans joining who are used to Lockbox payment mechanisms, that is absolutely not the same thing. This is Lockedbox mechanisms, and they're very much common when you've got private equity investors seeking to exit from an investment. So it's an alternative to the completion account situation. You've got a set of accounts at a fixed recent date, which is called the Lockbox date, which are warranted effectively, and there'll be extensive due diligence that our teams will undertake around that. One of the things that you obviously buyers will want to avoid is any leakage after the date of those locked box accounts taking place. So an example of that would be there's a very healthy profit and loss account sitting there, and before the transaction finalizes, a dividend could be paid, for example, and so there'll be items in the SPA that really work to avoid that kind of leakage, i.e. avoid value being stripped out of the business. You'll also hear talk about debt blocks and dividend blocks. Debt blocks, I guess, perhaps more it's a situation where, for example, fixed assets, where there may be a debt associated with that fixed asset, and when you actually look at the detail of the transactions, you actually find that if that fixed asset is sold, then the sales proceeds needs to be applied to the debt effectively. Dividend blocks, I've touched on dividends minutes ago, but this could be a situation, for example, and particularly with life sciences companies, whereby there's been a lot of product development costs, there's a lot of pre-revenue expenditure, there's a transaction taking place because the IP is great interest and great value, but when you look at the profit and loss account, there isn't actually distributable reserves that can be distributed by way of dividend there. So there's a block to actually undertaking a dividend. There's ways around that, and we see, for example, where there is large share premium in a company, capital reductions can effectively take place to rearrange the structure of the business to enable a switch to profit and loss. Again, very, very specialist area, so this is very much a generalist overview. do come to us for advice on that one. Moving on again. So perhaps my last topic before questions is really the whole area of accounting warranties, and what sorts of things can come up. Again, they'll be defined, written down, lots of definitions, etc. But some of the items are around: are we giving a true and fair view? What is actually being stated within the accounts in question? Are they subject to UK GAAP? Are we actually looking at IFRS? Have we got any warranties in place to say that they're consistent accounting policies between the statutory accounts and the accounts prepared either under the Lockedbox provisions or the completion accounts? And there may well be specific areas of provision that we need to look at. So working capital, hugely important. Have a look at bad debts. Does there need to be specific provisions against some bad debts that are taking place? Does there need to be some provision against slow-moving stock or even fixed assets? Capital commitments, liabilities, a couple of other areas where it's important to kind of thresh those out. Obviously, in terms of liabilities, such an all-encompassing term, but it's clearly in the buyer's interest to have those liabilities almost down to the T in terms of, are we including contingent liabilities there? Obviously, the greater the liabilities that go in, the lower the consideration, if that is being set against the consideration price. And so very much a need to think about every single type of liability there that could exist. Valuation's another issue, touched on fair value, but there could also be things like stock value. There may well be a need to have a look at that. Stock valued at the lower of cost and net realisable value. Well, what is net realisable value? And then also warranties around post-balance sheet events, and also any management accounts that come into play during the transaction. And finally, just to touch on another area, but one that just shows how many complexities there are here. There are also a ton of tax warranties to consider here as well. So between us, I think we've covered a huge amount of ground, and at this point, I'm very happy to pass to Ian for taking questions or further comments.
Thanks, Samantha, and thanks to all of our presenters today. We've got about 10 minutes, and I'm stunned by the silence of questions throughout the presentation. So I guess many people were assimilating the information provided throughout the sessions. But very happy now to take any questions from the attendees. Gosh, still assimilating. Okay. Okay, well, perhaps if we give people a minute or two just to think. Alex, just maybe just a question from me, if I may, just to get your general views on the volume of M&A activity in the last, let's say, sort of 6 months after the initial lockdown phase, where everybody was processing what it might mean for their businesses and their strategies. Just to get your thoughts on the general level of activity in the last few months.
Sure. We've seen a huge amount of interest in two sectors, really: the life sciences sector and the TMT, technology, media, telecoms, but primarily the technology side of things. So a lot of businesses have been impacted by the lockdown situation, either directly or indirectly, and therefore we've seen a flight to companies that have been largely unimpacted or had very little impact, or even positively impacted by the current situation. Hence, we've seen a lot of funds and other companies coming into the market to be able to make acquisitions in the life sciences sector. And so we've been particularly busy over the last 12 months, really, in particular, during that period of time. I think what we've also noticed is that people have been taking a closer look at some of the areas of the life sciences sector. So whilst we might expect this to be a little bit of a peak in transactions and volumes, I think some of the having invested time to understand certain subsectors, I think we'll see I think there'll be an element where maybe that might drop off a little bit, but I think we'll also see, I don't think we're going to go back to where we were before. And I think it's shone a bit of a light on certain areas we talked about in the presentation. And I think that will persist. Another trend that we're sort of seeing as part of this is also a lot of, as the UK private equity landscape matures, we're seeing more and more specialist funds popping up who are focused on, let's say, the life sciences sector in particular. And that's, I think, often a fund has to invest with the remit of investing across a number of different sectors. But I think there's a real a demand there for funds that really know and can really step outside of maybe some of the more traditional sort of service businesses that have been, really the focus for private equity companies into areas like products and pharma products and med devices, etc., where it requires a higher degree of understanding, but perhaps there's a little less competition, given that barrier to investing and understanding in some of those areas. So expect that to be a trend that continues over the period as well. So it's certainly an interesting time to be involved in M&A in the life sciences sector.
Very good. Yeah, thanks, Alex. I don't think we've got any other questions coming through. Oh, we do. Hot off the press. So question is, do we see a geographical direction of the money flow, i.e. more incoming investment or outgoing? That's a great question, and probably one, Alex, to put you back on the spot for.
This is a difficult question to answer. I don't have the data behind it to be able to support this, but we've certainly seen interest from overseas funds into the UK. So a lot of the funds that we interact with, obviously the core of what we see from an investment perspective in private equity terms has been UK funds investing in the sector, but we've also seen US funds and European funds investing in the UK as well. So I think at the moment we haven't seen, it still continues to be a good place to invest. I think there's quite a lot of stability in the investment, some of the rules and the regulations around investments in the UK. And there are some very interesting businesses and very interesting science that's been done in the UK. So I think as long as that continues, I think we'll still see money flowing in to invest in the UK market. But increasingly, given the competitive nature of the private equity market in the UK, with funds are increasingly looking at other geographies as well to invest and building a remit around investing in different territories. So yes, I think there's definitely flows both ways, but it's difficult to be able to assess exactly where that balance is struck over the last 12 months.
Great. Yeah, thank you, Alex. Okay. I may just pick on Carol, if I may, maybe just as a final question, unless there's any other questions from the floor. What's your hottest tip from your experience in the last 12 months, Carol, from having done deals? You may have mentioned it previously, but useful just to pick your brains on something that generated a lot of value for one of our clients. Sure.
I mean, it comes down to that preparation and not leaving tax to the last minute. The number of times I've come in and sort of done a due diligence and found issues that actually had the right advice being taken at the right time, they just wouldn't have arisen. And that it's kind of, I get why these issues arise again and again, but it's just having an awareness. I think that when you're doing those early stage things, have tax in mind and have one eye on the fact that at some point in future you might have somebody like me crawling all over it, picking holes, looking at it, say from a purchaser perspective and saying, is this robust? Can I get a price chip? Is there something here that I should be worried about that could actually bite me afterwards? Because that sort of thing with that proactive management can be avoided. So I think for me, it is just don't kind of put your tax off to tomorrow, do it today. That's my closing message.
That's a great line, Carol. I'll remember that last one. Very
there
good.
You go.
Very good. Fantastic. Okay, well, if there's no more questions from the floor, I'll wrap it up there. Just to thank everybody for joining the webinar. Hopefully you found it useful and there were some nuggets there. We will share the slides and the recording with everybody, and there are our contact details if you would like to reach any of us to discuss any of the topics on this session. Thanks very much also to the speakers. I've learned a lot as well through this, and we do hope you'll be able to join us again on our next webinar. Thanks very much.